Hey future millionaires, this is Phil from the Next Chapter team and welcome to another ETF review. Today's ETF review will focus on 4 ETFs from Fidelity. As we do with all our ETF reviews, we're going to do a deep dive on each one, take a look at the expense ratio, some of the stocks within the ETF, the performance over a 5 and 10 year span, and then at the end of the video, we're going to see what it would look like if you invested consistently in all 4 funds. But before we jump into the review, please take a moment to like, subscribe, and share. Now, sit back, relax, and enjoy another ETF review. Hey, now let's get started on the review. First, we're going to do a quick recap of what an ETF is, an exchange-traded fund, and how to buy these ETFs. As a reminder, today's ETF review will focus on the Fidelity Enhanced Large Cap Growth, the Enhanced Mid Cap, Enhanced Small Cap ETF, and then finally, a Consumer Discretionary Index ETF. An ETF is basically a basket or a group of investment securities that are traded on the stock market. And since they trade just like stocks, their price change all day. ETFs tend to have lower expense ratios and fewer brokerage commissions than some of its competing products. Now, how do you buy an ETF? First off, you determine what type of account you're going to buy the ETF in. Usually an IRA, an individual retirement account, or a brokerage account. Why? Because usually ETFs are not available in 401ks. But that's okay, you have other options. Second, you determine which investment broker you're going to work with. Third, you decide how frequently you're going to invest in these ETFs, weekly, bi-weekly, monthly. We usually tell people as close as possible to your paycheck cycle or at least monthly. Then you want to set it up to be an automatic transfer and an automatic purchase. The more automation you could add into your investment life, the easier it is, and the more disciplined you will become over time because of this automation. Here's a quick recap of some investment brokers that are out there: Fidelity, Webull, M1 Finance, Charles Schwab, E-Trade, TIAA Craft, and Vanguard. Of course, please do your own research. Find the investment broker that works best for you. Look for all the right tools and low commissions. Very low commissions is one of the big things you're looking for. Next up, in each ETF review, we're going to look at the ETF category, fund benchmark, fund summary, expense recap, top holdings, and finally that fund performance. That fund performance is going to help us do analysis at the very end of the video of what the account would look like if you invested consistently over a 5 and 10 year span of time. First up, we have FELG. This is your large cap growth. This one is a category of large cap growth, is seeking to index against the Russell 1000 Growth Index, at least 80% of its assets. And because this one is as close as possible as you're going to get to an index, it has a very low expense ratio of 0.18. So that means for every $10,000, you have $18 in expenses per year. Check out this ETF. The top 10 make up about 56.9% of the whole entire ETFs, and that includes 109 different stocks. Your top 10 include Apple, Microsoft, Nvidia, Amazon, Meta Platforms Class A, Alphabet Class A and C, Broadcom, Eli Lilly, and MasterCard. Next up, what sectors do you get? Information technology at 46%, communication services at 13.3%, and then consumer discretionary at 12.93%. After that, everything's under 10%, and you get a quick rundown: healthcare, industrials, financial, consumer staples, multi-sector, materials, energy, utilities, and then finally real estate. Let's check out that performance. 35.3 in the 1 year, 3 year 11.84, 5 year 19.59, 10 year 15.61. Not bad. And again, the expense ratio is 0.18. Next up is our enhanced mid-cap going by FMDE. This one ETF category is mid-cap blend. Again, this one is indexing 80% of its assets against the Russell mid-cap index. That expense ratio, 0.23. So for every $10,000, about $23 in expenses per year. All right, for this one, you hit 268 different stocks. And because you have so many now, let's take a closer look. Your total net assets on the top 10 is only 9.3. As you move down to the top 20, 17.6. Top 50, 36.85. And again, you have 268 different positions. Now, what companies are in your top 10? Tran, Cintas, Bank of NY Mellon, BY Mellon, Ross Stores, Spotify Technology, Republic Services, and Nucor Corp. Now, let's take that sector breakdown. Look at that. Industrials, 20.92. Financials, 14.90. Information technology, 14.43. And consumer discretionaries, 10.46. And after that, quick rundown. All of these are under 10%. Healthcare, materials, real estate, multi-sector, energy, utilities, consumer staples, and then communication services. Let's move on to that performance. Performance, 1 year, 16.23. 3 year, 4.36. 5 year, 10.58. And 10 year, 9.13. Jumping into our third ETF, we have the enhanced small cap ETF that goes by FESM, and its ETF category is small cap blend. This one is tracking against 80% of its assets and the small cap stocks included in the Russell 2000 index. This one has an expense ratio of 0.28, so which means for every 10,000, it's $28 per year. Moving into the holdings, you get 562. This is a large one. Nice index. All right, your top 10 companies only make up about 8.9. Top 20, 15.21. Top 50, 31.73. So again, 562 different positions. Now, what companies are in there? Top 10 holdings include Super Microcomputers Inc., Carvana, Abercrombie & Fitch, Class A, Amplified Industrial Technology, Matador Resource Company, SPS Commerce, Carpenter Technology, MicroStrategy, Class A, and Murphy Oil Corp. Now, let's take a look at that sector breakdown. You've got industrials at 18.23, information technology at 15.62, financials at 14.21, healthcare at 13.36, consumer discretionary at 10.15. After that, it drops well under 10, and we get industries like energy, multi-sector, materials, real estate, consumer staples, communication services, and finally, utilities. All right, now let's take out that look at that performance. All right, 1 year, 14.19, 3 year, 0.89, 5 year, 9.32, and 10 year, 7.74. Our final ETF is the FDIS. Again, that's FDIS. This is our Consumer Discretionary Index one. ETF category, Consumer Cyclical. What is this one indexed against? 80% of its assets go against the MSCI US Consumer Discretionary Index. And check out that expense ratio. Super low. Probably the lowest one I've seen in quite some time. It is 0.084. So that means for every $10,000 is $8.04 on this one. All right, this is a True Blue Index. It's got 274 different positions. Companies include Amazon, Tesla, Home Depot, McDonald's, Bookings Holdings, Lowe's, TJX Company, Nike, Starbucks, and Chipotle Mexican Grill. All right, so top 10 make up about 56.59. Top 20, 67.70, and top 50. So that means the top 50 of your 274 make up about 80% of the net assets. Now, let's go into the sectors. Sector diversification, broadline retail, automobile manufacturing, there's your Tesla, restaurants at 10.85. And after that, everything else is under 10%. Home improvement retail, hotels, resorts, and cruise lines, apparel, home building, automotive, retail, footwear, other specialty retail, casinos and gamings, automotive parts and equipment, apparel, accessories and luxury goods, and leisure products. Now let's jump into that performance. All right. Our 1 year was 11.39. Our 3 year, 0.84. 5 year, 13.08. And 10 year, 12.76. And again, super low expense ratio at 0.084. Finally, we're going to jump into what it would look like if we invested consistently in all four funds. All right, now jumping into it. First off, we're going to have someone investing into their investment account for roughly $8,000 per year. Now, as a reminder, we have four funds. First fund is our large cap, 1 year of 35.33, 5 year 19.58, 10 year of 15.61. Our mid cap, 1 year 16.23, 5-year 10.58, 10-year 9.13. Small cap 14.19, 5-year 9.32, 10-year 7.74. And then finally, our consumer discretionary index, that one goes up for 1 year 11.39, 5-year 13.08, and finally the 10-year at 12.76. And again, we're going to see what it would look like to invest consistently in all four funds over a 5 and 10 year span. All right, we're long-term investors. Let's see. All right, now first off, in 5 years, your balance would be 59,000. And what would the breakdown be? So 5 years of 8,000 makes 40,000. So 68% of your balance would be $40,000. That's your principal. You would have growth of 32%, however, in total on the balance. So that's $19,000. So $19,000 in growth. Now let's jump to that 10-year. Let's see how we do. Killing it. All right. Our 10-year, 153. See, long-term investing pays off. All right, so 10 years, $8,000 a year, $80,000 invested cash. Perfect. 52% of your balance would be just your principal. The remaining $73,626 would be all growth. Again, 10 years of investing consistently, $8,000, the portfolio would have been 153. Hope you enjoyed the ETF review. So many more to come. See you in the next one, and stay safe, keep investing, and make good, wise money moves.
Hey, thanks for staying to the end. This video is brought to you by the Next Chapter team. If you enjoyed the video, please take a moment to hit that like button, drop a comment, subscribe, share with your friends and family. This will help the channel reach out to more individuals just like you. We offer one-on-one coaching where we work with people and small businesses to determine a clear path to achieving their financial goals. This includes things like budgeting to reduce debts, planning for big purchases, and even learning how to build wealth with the tools that you have readily available to you. So please see our link below to schedule a free 30-minute call with our team to talk through coaching and understanding your current financial situation. Also, check out some of our affiliate links below for a high yield savings account. This is a great place to put your money when you're saving up for those big purchases and your emergency fund. Check out some of our videos right here. And please enjoy and see you in the next video.